Today we'll start with Unit 2 of Strategic Corporate Finance, Semester 4, uh, Master of Business Administration. Unit 2 covers, it's named as Financial Strategy and Economic Value Addition, that is EVA. There are four topics which we have to cover in this number of interaction between financial strategy and the overall strategies of the firm, economic value addition, factors affecting companies' financial strategy, and shareholders' wealth creation. So let us deal with them one by one. Financial strategy. Now, financial strategy outlines an organization's financial short and long term goals. Um, Financial strategy is nothing but organizations' goals and short and more of long term goals when it comes to what are its goals relating to its finances. There are three main components of organizations' financial strategy. We already know this: financing, investment, and dividends. So, if you remember, what are the main decision making strategies in financial management? There are financing, investment, and dividends. So, they are the three main components of organizations' financial strategy. Then, financing involves determining if using debt, equity, or a mixture of both is advantageous for purchasing assets. Again, the capital structure decisions form a very, very, very important part of the financial strategy. Now, interaction between financial strategy and overall strategy, if you look into this, marketing strategy, HR strategy, operation strategy, and financial strategy. So, as I said, as I insisted on my last lecture, that financial strategy is something which has to do with each and every component of the organization. Finance is the lifeblood of the organization, so it's a way, it's present everywhere. It is present in marketing, it's present in HR. Nothing can work without finance, and that is why when it comes to financial strategy, it has to be holistic. It should cover each and every aspect, and it should cover each and every department. It should cover from a small pin in an organization to big machines to supplier chain to everything to international business. Everything comes under financial strategy. So wherever money is involved, everything is within the financial strategy of the firm, and the interaction of the financial strategy is very omnipresent. Now, what is nature of financial strategy? Financial strategy is consists of analytical thinking. You cannot work out financial strategy without having analytical thinking. You should be very good at analysis. You should be able to look into future. You should be able to analyze the data. Then continuous process, it is not something which you can do it and you can get over with it. It is a continuous process. It keeps on happening on day to day basis. Basis of managerial decisions, there is no decision where finance is not involved. Maintaining balance between risk and profitability. So more risk, more return. But yes, there has to be a balance. If you take more of risk just for the sake of more return, then it may cause you huge losses as well. So there has to be a balance. There has to be a trade-off between risk and return. The coordination between process, there cannot be any coordination without finance. Centralized nature. So financial strategy should be centralized, because a person looking for financial strategy should be able to look into finances from overall organization's point of view. He should be able to cover each and every department. So he should have top-down approach while making the financial strategy. Now, scope of financial strategy, again, it consists of financial decisions, investment decisions, and dividend decisions. So, from where are you going to get the finances? Where are you going to invest the finances? And how much are you going to distribute among shareholders as dividend? That is the scope of the financial strategy. Now, factors affecting companies' financial strategy are nature of industrial sector. The financial strategy a company has, it depends on which industry it is surviving. Then company's profile. What is the company's profile? Whether it is MSME, whether it is blue chip, and what kind of business it is doing, whether it is going for some international transactions as well. So financial strategy depends on the company profile, depends on nature of industrial sector, it depends on the source of finances available to the company, management's philosophy, whether it is aggressive or they are conservative in nature, Then capital required, what is the amount, what is the quantum of capital required, what is the various sources from which capital can be taken. Then capital structure, what is the existing capital structure of the firm, whether it is having equity, more of debt, or whether it is a balanced or hybrid. Then flexibility, whether that financial strategy is flexible or not. And regulatory requirements. So regulatory requirements mean your capital structure, your financial strategy should also conform to the rules and regulations of the government. Now, decisions related to financial strategy. Now, financial intelligence. These are the decisions which are related to financial strategy, financial intelligence, analyzing financial data, past data, and predicting future data. The sources of funds, what are the sources of funds, usage of funds, management of funds, tax management, risk management, equity management, long term debt financing, working capital management, pension fund management, relationship management, organizational infrastructure, capital budgeting. So these are the things. For example, if you look into pension fund management, then organization may have pensions, may have pension fund which has been deducted out of the salary of the employees. Now, those pensions are to be given once the employee retires, and the management of that fund in a proper and their proper allocation, thereby making profits so that the pension can be given in a profitable manner, that is a big deal. And that is where the financial strategy comes into picture. So this is how these decisions are related to financial strategy. Now, economic value addition. We've already discussed this in second semester financial management. Economic value added is a measure of company's financial performance based on the residual wealth calculated by deducting its cost of capital from its operating profit, adjusted for taxes on the cash basis. It is nothing but no PAT minus weighted average cost of capital. So no PAT is a net operating profit after tax minus weighted average cost of capital. So EVA can also be referred to as economic profit, as it attempts to capture the true economic profit of the company. This measure was devised by management consulting firm Stern Value Management, originally incorporated as Stern Stewart and Company. EVA is the incremental difference in the rate of return over the company's cost of capital. So EVA actually what it does, it determines what is the rate of return over and above the cost of capital, because what we are doing is a NOPAT, that is net operating profit after tax. When you deduct weighted average cost of capital out of it, then you come to the real income, the value addition made by the company. Features of EVA approach: it converts accounting information into economic reality. Economic information is composes of various economic shortcomings, like historical concept and matching concept and all those things, and it is more of a conventional approach. But yes, economic value addition, the most important feature of economic value addition is that it converts accounting information into economic reality and serves as a guide to every decision. It can, because the value addition is the most important part when it comes to taxation also, and that's why it serves as a very good guide to every decision. Effective tool for investor communication: investors can communicate using the tool of economic value addition. And uses of EVA approach: setting organizational goals. You can set organizational goals on the basis of EVA. Performance management: determining bonus, because you actually know what value addition has been done by the company. So what we actually do is we determine the bonuses of the employees on the basis of what value addition has been done and what has been the net profit after deducting your weighted average cost of capital. And in a similar manner, we can decide the bonus. Then communication with shareholders and investors: it helps in communication with shareholders and investors. Motivation of managers, once why managers work, they work to add value, and if more of EVA is added, then it leads to motivation of managers. So next one is capital budgeting. It gives you an exact amount which is available to you for the dispensation, where you can use that particular amount for future growth, and that's how it helps in capital budgeting as well. Then corporate valuation, because it leads to increase in value addition, it also leads to uh, increase in the corporate valuation. And analyzing equity securities means it also helps in analyzing equity securities, because more of value creation uh, um, um, mm, leads to value creation, and it leads to more of equity pricing, more pricing of equity securities in the market. Now, adjustment for calculation of EVA. First of all, what we have to do is we have to deferred taxes are to be adjusted. LIFO, deferred taxes, means the taxes which were to be paid this year, but it has been deferred for the future time. And we'll discuss this in detail when we'll be discussing about MAT. LIFO reserves, that is a last in first out reserves. Amortization of goodwill, that is also to be adjusted, because that is amortization similar to depreciation. So that is to be, and that is a non-cash expense. And capitalized intangibles, whatever intangibles we have capitalized, that are also to be added back, because that will lead to cash creation. Other reserves and allowances, whatever other allowances and reserves we have deducted out of the profit, and which are not in the cash format, or which are not in the operating format, then we'll have to, which are not in cash format, then we'll have to add them back. EVA is equal to return on capital minus, this is a bit of a problem. Let us uh, just hold on for a sec. Here we go. Return on capital minus cost of capital into capital. So, or you can just change it as a NOPAT, that is net operating profit after tax, minus whatever capital, total capital you have, into cost of capital. So NOPAT minus capital charge. This is the profit, the value addition in the whole year, and this is the cost you paid for the capital you sourced. So once you deduct this, this is the economic value addition, the total value addition. What are the merits? Helps the company in monitoring the problem. It improves the corporate governance. It presents a better and true picture. It identifies the best person to run the companies effectively, evaluate the projects independently. So these are the merits of economic value addition. It helps in the monitoring, the company in monitoring the problem. The problem can be easily monitored. If your EVA is declining, then you need to really think about what is the problem with the company, and improve the corporate governance, because it is very transparent. Value addition is something which every stakeholder is looking for, and it helps to improve the corporate governance. It helps to improve the transparency. It presents a better and true picture, because creation, value addition is something which is the most aspiring goal of any corporate, and it helps us to present a true and better picture of the financial statements. And identify the best person to run company effectively. It is very easy. The person who is leading to more of economic value addition, he should be the best person to run the company effectively. And evaluate the projects independently. It helps us to evaluate the projects independently, because it helps, whichever project gives you more of value addition, economic value addition, then you can just select that project. Demerits: more suited to established companies. It is not for the new companies, because new companies don't have not created any value yet. Depends on financial statements based on accounting principles. So again, it suffers because it is based on NOPAT, which is not net operating profit after tax. All the deficiencies, whatever is there in financial statement, again, they are deficiencies of this economic value addition. Short-sighted approach, because you're looking for just present value creation and you are making the decision, and not a very helpful diagnostic techniques, because of all these factors. And also there are many other factors which help in which are very important, except value addition as well. For example, the employee welfare. So this is the next one is shareholders wealth creation. The principle of shareholders wealth creation. First of all, let us understand what is wealth creation. Maximization of EPS. If you remember, I told you in second semester that maximization of EPS is the final goal for which any organization is working. So earning per share, market price per share, they should be maximized. The principle of shareholders wealth maximization holds that a maximum return to investors is and ought to be the objective of all corporate activity. So that is the shareholders wealth maximization. That is maximization of shareholders wealth is the only objective for all corporate activity. Now, from a financial management perspective, this means maximizing the price of the firm's common stock. So maximization of earning per share, maximization of market price per share, that is the sole motto behind the working of any corporate. Now, features are distinct and simple to understand. We already discussed this in the financial management second semester. So it is distinct and simple to understand because, yes, the owner's wealth has to be maximized. It is simple business that whosoever is investing, his money should be maximized. That should be the sole aim. Important aid to investment decisions, time adjusted present value because market price discounts everything. So it time adjusts also, maximizing economic well-being of the shareholders, takes both quality and quantity standards for the benefit, integrates time value, risk, and uncertainty factors because market price of any share integrates all these factors: time value, risk, and uncertainty. Market price per share as standard, avoids agency issue in an organization. Organization gets rid of agency issues. It gets rid of other issues which are not related to shareholders' wealth maximization. Eliminates the limitation of profit maximization concept because profit maximization concept is a short-term concept. It targets at the profit maximization, the maximization of profit after tax. Here, in this shareholders wealth maximization, we are taking care of market price, which means we're looking at maximization of capital, market capitalization of the firm, and that is the sole mm, uh, criteria to select to for any corporate to exist, because it is very important to increase the shareholders wealth. It is very important to increase the market value of the shares. Now, importance merits better than profit maximization, comparison of value to cost associated, considers time value risk factors, promotes and improves the optimum and efficient utilization of scarce resources, because here you are striving to improve the market value of the firm, and that is only possible if you're efficient, if you have efficient and optimum utilization of scarce resources. It promotes economy and aims to fulfill economic obligation of the society, because once the market price of the shares goes high, the market capitalization of the company goes on the higher side, then only it can go for social motives and can invest in social norms as well. Now, next one is demerits. Incorrect assumptions are there. Uh, uh, because see, when you look into stock market, sometimes it is manipulated. So assuming that the market price represents shareholders' wealth, and that leads to welfare of the shareholders, is a bit more of assumption. Is speculation, it leads to speculation, but because sometimes the stock prices may go on higher or lower side only because of the speculative nature of the market for the investors in the market. And varied objectives, there are varied objectives of shareholders. There cannot be just one objective to maximize his own wealth. He may be there for some dividends, or he may be there for some other motive. Then justice to all social groups, then all the social groups are not getting the justice. Actually, what happens is the person who is investing, the investors are getting the returns, and thus social justice, social groups are all the social groups are not getting. So that is not actually social concept. Then so with this we come to end of second unit. I hope you enjoyed the session. Thank you. Thank you.